Good evening and welcome to iBanker News Tonight, part 2 on this beautiful Tuesday, February 3rd, 2026. Thank you so much for all the support. Really enjoy all the comments, all the suggestions for new stories. There's so many things we want to cover that CNBC, Fox Business, Bloomberg, and the rest just won't touch. And today, really what I want to talk about is something near and dear to my heart, value investing. And so we're going to go into something. One of the reasons I started this channel was I was kind of sick of seeing essentially everybody on the financial press getting kind of suckered in that third phase. Obviously, there's the accumulation phase, the markup phase, the distribution phase. That's you. And then there's the markdown phase. And so essentially what value investing is all about is identifying assets. So this is for conversational purposes only. Obviously, you should do your own research, talk to an investment advisor. I'm not your investment advisor. I'm not recommending you buy this, but as a thought exercise, I think this is a really fun one to get into. And so without further ado, let's jump into it. Let me ask you something that should bother you. How does the most disciplined investor in modern history, the man who built $1 trillion empire by not chasing shiny objects, end up missing one of the most powerful wealth creation machines of all time? Not because he was reckless, not because he was lazy, but because he was too faithful to his own success. That man, as you probably have guessed, is Warren Buffett. And the story starts with Benjamin Graham. Benjamin Graham was not trying to get rich. He was trying not to get wiped out again. After watching fortunes evaporate in the Great Depression, Graham developed a simple, almost moral philosophy. Markets are emotional. Humans are irrational. So you protect yourself with numbers, price to earnings, price to book, cash flows. Most importantly, a margin of safety. Buy businesses for less than they're worth and wait. That philosophy saved Warren Buffett's life financially and then made him the most successful investor who ever lived. Coca-Cola, American Express, See's Candy, so many more. Simple businesses, predictable profits. Cash that shows up now, not promises about tomorrow. And for decades, it worked beautifully. Then came Amazon. Not the garbage startup, not the dot-com bubble insanity. Amazon after it had proven dominance, after it had scale, after it had logistics, data, prime lock-in, and AWS quietly printing money. And still, Buffett did not buy. Why? Because Amazon didn't look like a Graham stock. Margins were thin by choice. Earnings were suppressed intentionally. Every dollar went back into growth. The value wasn't visible and was not visible in the income statement. It lived in the future. Buffett later admitted it publicly as one of his biggest mistakes, not because Amazon wasn't valuable, but because it didn't look valuable using the tools that had always worked. That matters a lot. Fast forward to today. Buffett owns Apple, not as a tech stock, as a computer monopoly with pricing power. He owns energy, insurance, Japanese trading houses. He's sitting on hundreds of billions in cash. Patient, careful, disciplined. And once again, the market is changed around him. Zoom out. The S&P 500 today trades around 22 to 25 times earnings. That's historically elevated, driven largely by mega cap tech. Meanwhile, the pharmaceutical sector trades cheaper, roughly 16 to 20 times earnings on average. Already a discount. But inside that sector, there's a name trading even cheaper. And this is where the story gets uncomfortable and interesting. Let's talk about Merck. A company older than most countries, a global pharmaceutical franchise, life-saving drugs, massive R&D, durable demand. And yet, Merck's trailing PE is approximately 12 to 14 times. The pharma sector trailing average, by comparison, is between 16 and 20 times. The S&P 500 PE, of course, as stated previously, is 22 to 25 times. Let that sink in. Merck is trading at a discount to its own sector and at nearly half the multiple of the broader market. That's not a narrative, that's math. Now look under the hood. Free cash flow, roughly $13 billion annually. Free cash flow margin, about 20%. Gross margins, approximately 80% plus. That's huge. And return on invested capital, ROIC, around 30%. Those are not distressed company numbers. Those are high-quality business numbers. In Benjamin Graham's language, strong earnings power, real cash, and a margin of safety. In Buffett's language, a durable business throwing off cash at scale. And yet the stock is priced like it's permanently broken. Why? Because pharma isn't exciting. Patent cliffs, regulatory pressure, no viral growth story, no AI buzzwords. It's boring. It's slow. It reminds people of mortality, not moonshots. And markets don't like boring. Markets like stories. This is the same psychology error inverted. Amazon looked too expensive because profits were delayed. Merck looks too cheap because growth is unloved. Different era, same mistake. Now let me show you. Slow this down for 1 second because this matters. This is not a recommendation to buy Merck. This is not investment advice. This is not an inducement to invest. This is a conversation about valuation, history, and how market misprices things. Do your own research, talk to professionals, know your risk tolerance, and okay, back to the point. The lesson isn't that Buffett is wrong. The lesson is that even the best investors in history are shaped by the world that made them successful. Graham taught Buffett to fear loss, and that saved him. But sometimes fear, even rational fear, causes hesitation. Today's market isn't cheap overall, but value still exists. Quietly, uncomfortably, in places people don't want to look. And the irony is this. The next great miss usually doesn't look reckless, it looks reasonable. If you want more conversations like this, not hype, not pump and dump nonsense, but real history, real numbers, and real human psychology, subscribe to this channel. We don't just talk about what the legends bought, we talk about what they missed and why. Because understanding where value hides is more powerful than chasing what already ran. I'll see you on the next one. Until then, take care of yourself and each other.